Hello everyone, in this video I will explain about supply chain finance. So before we start, let me introduce myself. My name is Fadhilah Salsabila. I am a student at the Institute of Transportation and Logistics Trisakti.
What is supply chain finance? Supply chain finance is a term describing a set of technology-based solutions that aim to lower financing costs and improve business efficiency for buyers and sellers linked in a sales transaction. Parties involved in supply chain finance activities. The first is the supplier, which is the party that provides a product. Suppliers can sell invoices for the purchase of goods to banks or other financial institutions. The goal is to get business capital. The second party is the buyer or buyer. The buyer here is the party who uses the product from the supplier alias the supplier. In buying and selling transactions, suppliers usually provide short-term payment deadlines. The third party is the lender, in this case, banks or other financial institutions. In supply chain financing, the lender becomes an intermediary between the supplier and the buyer by purchasing the products from the supplier. The lender's involvement in this financing allows the supplier to get capital so that it can be used to run its business. Meanwhile, the second party, the buyer, can extend the payment term. Funding with the SFC method is chosen by many business people, especially those whose status is still small scale. This is done so that business activities can still run. In addition, the company's cash flow also remains smooth. Financial institution. They are commercial banks, thrifts, which include savings and loan associations, and savings banks and credit unions. These three types of institutions have become more like each other in recent decades, and their unique identities have become less distinct. Why is SEF important in supply chain? In the context of international supply chains, a number of suppliers are smaller companies with limited credit liquidity and a higher cost of funding than their buyers. As the credit risk of financing the receivables is predicated on the better-rated buyer, SEF helps to reduce financing costs for these suppliers. Depending on the payment terms, it can also be beneficial for the buyer, resulting in a win-win situation. How supply chain finance works. When using the SEF method, suppliers can sell their invoices to finance providers or banks. With this system, suppliers can have access to money more quickly and easily. Easy access to money will help suppliers maintain a smooth and balanced cash flow. That way, business activities can also operate smoothly. Meanwhile, from the buyer's side, there will be many opportunities to pay bills that must be paid. Buyers can also be more relaxed in carrying out various financial activities. SEF provides a win-win solution to both parties, namely buyers and suppliers. Benefits of SEF. For the buyer, reduce the cost of goods purchased, reduce working capital requirements through improved days payable outstanding DPO, improve visibility across the financial supply chain. For seller, reduce the cost of capital through improved days sales outstanding DSO and lower finance costs, generate flexible, predictable cash flow, gain access to low-cost finance rates. That should be considered in SEF implementation. First is vendor onboarding processes. Second is large versus smaller suppliers. Third is emerging market infrastructure. And fourth is optimizing banking capacity. Okay guys, maybe that's all I can explain about supply chain finance. So don't forget to like, comment, and subscribe.
See you. Bye-bye.